Welcome to the Deep Dive. Today, we're jumping into, well, a really popular one, the Schwab U.S. Dividend Equity ETF. You probably know it as SCHD. Lots of people hold it, lots of people talk about it.
Absolutely. And, people often focus on the yield, maybe the performance, but the real engine room, secret sauce, it's the methodology. We're not just talking dividends in general. We're going deep into the index that follows the Dow Jones U.S. Dividend 100 index. And honestly, that index is like a super strict bouncer for stocks. It's designed to filter for quality.
Right. So our mission here is basically to unpack that rule book. We want you to understand exactly how SCHD picks those 100 companies, because it's built to do two things at once: give you steady, sustainable income and potential for solid capital growth. Think of this deep dive as your shortcut to understanding why it's built the way it is.
Okay, so let's start at the very beginning. The objective. SCHD is passive, right? Its job is just to track the total return of that index. And the strategy behind that index is super clear. Find large cap, maybe some mid cap U.S. companies that have a solid track record of paying dividends and really strong financial fundamentals. The whole game is about dividend quality and sustainability. Can they keep paying? Can they grow it?
Okay, so where does it even start looking? What's the initial pool of companies?
It casts a wide net initially. Starts with the Dow Jones U.S. Broad Stock Market Index, huge universe. But right away, some filters kick in. Exclusions based on company structure.
And what gets kicked out right off the bat?
Two main types: real estate investment trusts, REITs, and limited partnerships, LPs. They're just not eligible for a consideration, period.
That's interesting, because REITs especially are known for high payouts. Why exclude them?
They are, yeah. But the index philosophy really hinges on these, let's call them traditional cash flow metrics. We'll get into those. REITs often have kind of unique financial structures, partly because they have to pay out most income by law. That doesn't always mesh with the specific financial health tests SCHD uses. It's looking for companies that generate so much extra cash they choose to pay dividends, not ones that are sort of legally obligated.
Got it. So that choice itself is a quality signal. Okay, field narrowed. Still a lot of companies, though. What's the absolute first hurdle? The non-negotiable test for resilience.
This is probably the first big aha for people looking under the hood. A company absolutely must have paid dividends for at least 10 consecutive years.
Wow, a full decade. Okay, but doesn't that automatically cut out younger, maybe really innovative companies that might become great dividend payers down the road?
Oh, absolutely it does. And that's intentional. It's a trade-off. The index isn't hunting for the next big thing. It's looking for the proven thing. That 10-year rule basically ensures the company's established, it's resilient. Crucially, it means they kept paying through at least one economic downturn. It's about minimizing risk, maximizing reliability, not chasing hype.
Resilience first. Makes sense. Okay, so they clear the 10-year bar. Now, you said it goes way beyond just yield. This is where the quality screening really happens to avoid those dreaded value traps. Tell us about these four key metrics, the special sauce.
Right, this is the core mechanism. After the 10-year check, the remaining stocks get ranked. And the ranking is based on a weighted mix of four fundamental factors, all aimed at proving the business itself is sound.
Okay, lay the first one on us.
Number one, financial health. They measure this using free cash flow FCF relative to total debt.
Okay, hold on. FCF, free cash flow. Just remind us, simply put, what is that cash left over after everything?
Pretty much, yeah. Operating cash flow minus what they spend on maintaining and expanding the business, capital expenditures. It's the cash that the company really has free and clear. That's what sustainable dividends should come from. And SCHD compares that cash pile to the company's total debt.
So the ratio is key. Why FCF relative to debt? Why not just look at the total debt amount?
Because context is everything. A huge company might have billions in debt. Sounds scary, but if it's generating way more billions in FCF each year, that debt's manageable. This FCF to debt ratio directly measures their ability to pay back debt. High ratio means they can handle liabilities and still have plenty left over for shareholders. It's like the ultimate, can they afford this check?
Okay, that makes total sense. Prove you can afford the debt and the dividend. What's metric number two?
Number two is about efficiency, measured by return on equity, ROE.
And ROE tells us. What about a dividend stock?
It shows how effectively management is using the money shareholders invested to actually generate profit. High ROE suggests the company isn't just sitting on cash or wasting it. They're good at turning investments into earnings. And if management's effective, well, the profits and the dividends are likely more reliable. High profitability is what we want.
Right, so financial health check, management efficiency check, those two alone seem like powerful shields against those value traps, the companies that look cheap but are actually sinking. What about the actual income part, the yield people want now?
That's metric 3, income focus, measured by the plain old annual indicated dividend yield. Now, SCHD doesn't just chase the highest yield out there, but it does make sure the final portfolio offers a decent current income. So yield does factor into the ranking, but only after those first two quality checks are passed.
Weighted, okay, but not the top priority over financial health.
Yeah.
Got it. And last one looks ahead.
Exactly. Number 4 is sustainability and growth. That's the 5-year annual indicated dividend growth rate. This isn't about today's payout amount. It's about how consistently they've increased that payout over the last 5 years. It's a sign of momentum, of management's confidence in the future.
So it brilliantly balances the now current yield with the track record of growth. That suggests the income stream might actually keep up with inflation or beat it. That seems key to the total return idea. Okay, so they rank everyone based on these 4 things, weighted somehow. How do they pick the final 100?
It's pretty straightforward at that point. They just take the top 100 highest ranked stocks based on that composite score. But crucially, there are 2 more layers of diversification rules, kind of like safety nets.
Safety nets, okay. What are they?
First is at the stock level. No single company can be more than 4% of the index's total weight. Second is at the sector level. No single industry sector can make up more than 25% of the total weight.
That 25% sector cap seems huge. Means you can end up, say, 50% in banks, even if they all scored incredibly well that year.
Exactly right. It forces diversification within the quality dividend space. Prevents concentration risk, so if one whole industry hits a rough patch, it doesn't tank the entire fund.
And how often do they redo this whole process, rebalance the index?
Annually, once a year, which keeps turnover and trading costs down and fits with that long-term fundamental view. It's not trying to time the market day to day.
Makes sense. Okay, let's talk benefits. We've hit quality hard, but the cost structure, that's a major plus too, isn't it?
Oh, huge. It's a passive index fund, so the expense ratio is typically rock bottom, usually around 0.06%.
Yeah.
When you're investing for income over, decades potentially, keeping fees that low makes a real difference to your actual take-home return.
Yeah.
Super competitive costs.
Yeah, that's tiny. But the big operational win, like we talked about, is dodging those value traps.
That's really the heart of it. A value trap often lures you in with a high yield, but it's masking deep financial problems. Those FCF debt and ROE screens we discussed, they actively weed out companies that look cheap but might be drowning in debt or losing money. By demanding proof of profitability and manageable debt, SCHD sidesteps a lot of those potentially weak businesses.
And practically speaking, for the investor, you get that income regularly, pays dividends quarterly.
And the bigger picture there is total return. Because it focuses so hard on companies with financial strength and that proven dividend growth. Remember, the 5-year growth metric, SCHD, tends to show good potential for long-term capital appreciation too. It's not just about the income checks. You're not necessarily giving up all growth for yield.
Okay, but no free lunch, right?
Yeah.
This strict approach must have downsides, limitations. We mentioned one already, universe restriction.
Yep, it's U.S. companies only, full stop. So if you want or need global dividend exposure, SCHD can't be your only holding. You'd need something else alongside it.
And those exclusions at the start, REITs, LPs, plus the high bar for the metrics, it means certain sectors just won't show up much or at all, especially high growth areas.
That's right. Think about, some of the big tech giants, the real growth darlings. Often they plow profits back into the business, R&D, expansion, not into paying big dividends. So maybe their yield is too low or they don't have that 10-year dividend track record yet. They get filtered out or their weighting is minimal. And that leads to a definite structural bias in the portfolio.
Which is?
A value tilt. Almost by definition, SCHD ends up leaning heavily towards traditional value sectors. You see a lot of financials, industrials, consumer staples, healthcare, companies known for stable cash flows. It's naturally tilted away from those pure, high-growth, maybe tech-heavy sectors.
And the annual rebalancing. Good for costs. But what's the potential risk of only checking the holdings once a year?
Well, it can create a lag. If a company in the index suddenly hits serious trouble, maybe a bad acquisition tanks its balance sheet, or profits collapse between reviews, the index won't kick it out immediately. It might hold on to a deteriorating company for, several months until that next annual rebalance. It can be slow to react to sudden bad news.
And lastly, performance in different market types. Specifically, those really hot bull markets.
Yeah, in those rip-roaring bull markets, the ones led by, say, non-dividend paying tech stocks or more speculative growth names, SCHD will probably lag behind broader market indexes like the S&P 500 or pure growth funds. Its quality and value rules are just too strict for it to fully capture those kinds of speculative surges. It's built for stability, which means sometimes missing the highest highs.
Okay, so pulling it all together, this deep dive shows SCHD is, well, it's a really effective quality filter put into an ETF wrapper, engineered specifically for dividend sustainability, backed by those clear fundamental rules.
Exactly, and that tells you exactly who it's best suited for. It's really ideal for investors who need reliable, hopefully growing income over the long haul, people counting on those dividend checks. It's also great if you want exposure to companies with genuinely strong financial health, low debt, good profits, but you don't want to do all that research yourself.
Right. It acts as this really well-defined value or quality anchor within a
Yeah.
bigger, maybe more diversified portfolio.
Right.
That part is playing defense.
Which brings us to maybe a final thought for you, the listener, to chew on. SCHD makes financial health FCF debt, ROE, the absolute price of admission. So think about this. If you ignore those kinds of metrics and just chase the absolute highest dividend yield you can find, are you really investing anymore, or are you just kind of speculating, hoping that dividend doesn't get cut?
That's the core question, isn't it? Whether you end up using SCHD or not, understanding those 4 quality metrics gives you a powerful checklist. You could use it to judge the potential sustainability of pretty much any dividend stock you consider down the road. Thanks for diving deep with us today.